Welcome to Trading Nation. I'm Brian Sullivan. Thanks for joining us today. We are also joined by Sam Hartzmark, Assistant Professor of Finance at the University of Chicago's Booth School of Business. Sam, welcome. In our new research paper, this is really interesting. You talk about what you call the free dividends fallacy and basically how people, most investors, unfortunately, really screw up capital gains and dividends. What is your thesis and what is your conclusion?
So our thesis is pretty simple, which is that investors are making a fundamental error in how they're thinking about dividends. So what finance has told us for a very long time is that an investor, kind of all else equal, should be indifferent about whether or not they receive a dividend, and that's because a dividend is exactly offset or roughly offset by a drop in price. So it doesn't make you better or worse off without some frictions. What we show in the paper is that investors seem to miss this and treat dividends more like, say, coupon payments for a bond. So they wrongly view it as additional income as opposed to just kind of shifting money from, say, the stock price to the cash of a dividend.
And so what would be then the solution to this problem other than yelling at investors, hey, stop it?
So I'd say there's a few things investors can do. So one is to actively pay attention of where their dividend income is coming from. So for example, if you look at brokerage statements, oftentimes you'll see price changes and then you'll see a dividend number aggregated altogether without regard to kind of where it came from. And so in doing so, investors kind of miss the fact that this dividend is coming at the expense of the price drop. And so they view it as kind of a separate source of income, even though it's not independent of this price level. It's not free money, which is how they seem to behave.
Yeah, and so what was the most surprising thing from your research? Was it just this type of, because it's not, and I mean this with respect, it's not that complicated of a concept. I mean, a dividend is a cash payment, and you look at gains in bonds. What was the most surprising thing about this? Was it just that people didn't just get it?
So not necessarily. So I have some previous work related to dividends that kind of suggested that people were missing this. And so this paper kind of, I think, demonstrates that. But I'd say the most surprising thing is we look at kind of how investors value this stream of income over time. And probably the closest thing, if you view this similar to, say, a bond coupon, would be, the interest rate, what bonds are actually paying off. And so what we find is that actually dividend-paying stocks seem to be systematically over and undervalued based on things like the level of the interest rate and recent market performance. So this shifts it from kind of something where investors are indifferent to investors are systematically buying over and underpriced stocks that result in kind of lower expected returns because they're buying, they want dividends when everybody else wants dividends, and this pushes up the price and lowers the expected return. So now it kind of breaks this indifference that you shouldn't care about dividends to now when everybody else wants to buy dividends, you probably shouldn't want to buy dividends. So it suggests it's kind of a bigger mistake than just missing the trade-off.
So avoid dividend stocks right now, maybe. That's why people are selling REITs.
Yeah, so I'd say, I mean, right now you look at, say, the book to market of dividend-paying stocks or other measures of mispricing. It looks like there are lots of investors who have kind of piled into dividend-paying stocks.
Yeah.
Vanguard closed one of its large dividend funds over the summer. And we've got a few measures of dividend demand that it stops in Q2 2016. But the first half of 2016, we've got a return-based measure of what happens kind of post-announcement and before the stock goes X. And that measure, at least, has been very high, which suggests that dividend demand is quite high, and these stocks are somewhat relatively overpriced.
Really interesting stuff there, Sam. Contradicts a lot of what they call the conventional wisdom, which is generally not that wise. Sam Hartzmark of the Booth School of University of Chicago. Sam, we'll see you back here again, I hope, someday. Thank you very much for joining us.
Thank you so much.
Folks, thank you for watching Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.